Hello and welcome to Livewire's Buy, Hold, Sell. My name is Chris Conway. Spring has sprung and that means horse racing is taking centre stage down here in Melbourne, where we are shooting this series of Buy, Hold, Sell. Today we're focusing on the stayers, enduring performers that keep compounding year after year. Joining me is Nick Pashias from Antares and Marcus Ryan from Yarra Capital Management. Gents, before we talk stocks, I just wanted to ask, are you interested in the spring racing carnival at all, or do you confine your risk-taking just to markets? Marcus, I'll come to you first.
Thanks, Chris. It's great to be here. Look, interesting question. I'd say they're quite two different propositions, horse racing to share market. But even in carnival season that we find ourselves, look, my focus remains more on share market opportunities, albeit the investment opportunities here are much more longer dated and much more patience is required relative to, I believe, around the 3 minutes and 20 seconds that the average horse takes to complete the Melbourne Cup, the race that stops the nation.
You've done your research, mate. Well done. Nick, what about you? Do you enjoy the nags at all, or just on the market?
Yeah, well, I come from a long line of punters, but It definitely skipped me.
Okay,
no,
okay.
Not really, not me.
Fair enough, fair enough. All right, let's sharpen up. We're going to talk about some companies, of course, but I just wanted to understand when I say enduring performer or quality compounder, what that means to each of my guests. So Nick, what conjures up in your mind when I say those terms?
Yeah, it's something that is repeatable, something that has recurring revenue streams, that's sustainable in that sense, and it's something that has a big TAM to grow into by definition, and it's got a moat around it, so not easily penetrated by competition. There's something unique about it. They're the kind of attributes that we look for.
Yep, and what about you, Marcus? Similar sort of story? Anything else you look at?
Look, there's some very similar themes there, but I think definitely from our perspectives across our portfolios, getting the focus on quality and quality exposure to companies that have the capacity to compound earnings over time is really important. And really, I think quality to us, it's more of a fundamental kind of qualitative assessment. And we think of themes like market position. We think about pricing power. What capacity does this business have to offset higher input costs into its business with higher pricing? We think about management quality. Is this the type of management that can grow into the opportunity before it? And just lastly, financial sustainability. Is this a business, and really that's just a fancy term for saying, does the company have the right amount of debt at that point in time to navigate the risks and opportunities ahead?
Makes sense. All right, we'll get into the meaty part of the Buy, Hold, Sell episode. The first stayer that we're going to run the rule over is Car Group, the old car sales, established in 1990. Digital vehicle marketplace, as many people would be well aware. Operations here in Australia, South Korea, the US and Chile. Marcus, buy, hold or sell for you?
Car to us is a buy. Car is one of our preferred names in the classified space, sitting amid the much larger communications services sector. To us, car is a real structural compounder. We like the large and diverse end markets that the business is growing into. We like the product depth. We like the pricing upside as the network effects grow in their markets. Car is the type of business, Chris, that looking forward we can see growing top line at around 10% double digit, translating into double digit profit growth. What we're observing is this company is trading at about 30 times earnings. So for that quality of earnings and for that durability, that point that Nick highlighted, the capacity to repeat those earnings, we see that as a good place to be.
So buy for you, Marcus. Nick, Car Group has had a tough 12 months in terms of the share price, down around 5%, not devastating, but not as good as the broader market. Buy, hold or sell for you?
I'll give you the punchline in the end. Let me give you the story.
Okay.
So, investment like driving, you got to look in the windscreen, through the windscreen, not through the rear vision mirror. So you got to look at things at a point in time, right now, looking forward. And we see some structural issues ahead of Car Group, and that is a declining user base. Younger people in particular are not getting their licences. So by definition, they're not buying cars, and so that big TAM that we spoke about as a key attribute for these types of stocks, we feel is under pressure. There's a whole host of reasons why that might be, whether it's Uber or autonomous vehicles really haven't hit anywhere yet, but that's another risk in the terminal value of Car Group. Now, car management are very good. They've seen this, we think, and made great acquisitions and diversified the business. You mentioned the geographies that they operate in. They also diversified into verticals. But the issue that that's had is it's increased complexity to the business. It's increased cost, and it's taken away the leverage, the operating leverage to that top line, which is attractive that Marcus spoke about. And you can see that in the numbers this year. I think their revenue growth is higher than their EBITDA growth, which implies market compression. And so for those reasons, and it's still trading on a 32 times multiple, but we think it's a cyclical stock that's priced as a growth stock. So it's a sell.
There you go, a sell. All right, we'll shift gears. Next, we're going to have a look at CSL Limited, one of the best companies that Australia has ever exported to the world, in my humble opinion. Of course, involved in the development and manufacture of biopharmaceutical products and vaccines. As if I need to tell people that. Everyone knows CSL. Nick, I'll stay with you. Buy, hold or sell for this one?
Yeah, this one's a buy. Again, trying to look forward. It's been no doubt a difficult and painful resetting of expectations. I think it's a lot to do about focusing on the wrong things in terms of the margin that they guided to, which they haven't hit. Now, it's poor communication, it's currency, it's execution that have led to it. But we are where we are. So look at the business now going forward. The key attribute or the key business is the bearings business, which we still think demand is growing at mid-single digits. You'll get 1 or 2% pricing growth on top of that volume growth, and which is a good top line. And from here on, they've initiated a number of efficiency programs, which should see margins starting to expand in the short term. And over the longer term, you've got what they call their Horizon 2 initiatives, which are about manufacturing. They're longer dated. But we think that right here, right now, you're getting something on a little bit more than a market multiple, low 20s multiple, and it should grow in the teens. And so we think that that's pretty compelling. They've got a lot of work to do. They have to execute. They have to rebuild credibility. They're a proud company, chairman included, and I think that's a great motivator.
Yep, makes sense. Marcus, CSL, some of the pain Nick was just talking to, it did have a tough reporting season. I think it was down around 15% on the day, which is unheard of for a stock like CSL. Down 27% over the last 12 months. Are you seeing any value? Is it a buy, hold or sell for you?
To us today, Chris, CSL would be more of a hold. And if I was to summarise our view on CSL today, it would be that CSL today is not quite the business that it was yesteryear, and the earnings outlook is not quite as attractive as what we've seen delivered in prior years. Three of the key points that would highlight with CSL. Firstly, the business mix and the industry exposure is different to what we've seen in prior years. We could talk a little bit about the V4 acquisition. Some would say that is now history, 2022 acquisition, but it has had an impact on the ROE of the group. We'd also call out competitive dynamics and product substitution risk that we see has actually accelerated in the last 6 to 12 months. And that's particularly been around some of the high margin parts of the CSL business in that bearing franchise. And then just finally, when we think about the biggest market for CSL, which is in the US, we think the backdrop there is also a little bit more challenged than what it's been in prior years. We could talk a little bit about regulation, we could talk a little bit about the prospect for US pharmaceutical tariffs. So just building on Nick's point, however, we actually see recent changes that the company is initiating to address some of these issues. We would support them. We think they have merit to streamline the business. However, we think it'll take time for the fruit to come. We see opportunity cost of sitting in the stock today, and we just don't see that earnings visibility as clearly as some others.
All right, we'll round out by talking about one of the hottest segments in the market right now. It is, of course, gold, although we're filming on a day where the gold price was down a little bit overnight, but it's been one of the hottest trades all year. We're going to talk about the biggest player in the space, $37 billion market cap, Northern Star Resources. Marcus, I'll stay with you. Buy, hold or sell?
NST would be a buy for us. It'd be our favoured large cap gold stock. For us, NST, it's not just a mono call on the gold price, and there's a bunch of stock-specific factors that we think really supports the position. So firstly, just the quality of the assets, and we observe, for example, the long life of mines. The organic production growth that sits within the business. We could talk a bit about Super Pit in WA, and that's driving some quite attractive production growth in the years ahead. We like the management quality, board governance. They've had a strong track record around capital management. Brings us to valuation, where we think NST today is really trading at only a modest multiple premium to gold peers, but has a much more attractive growth profile. Hypothetically, if the gold price was to stay at these levels of around US $4,000 an ounce, it's quite interesting, but that would actually suggest earnings 12 months forward could come in around 50% ahead of a market consensus view. So we also see kind of a strong earnings momentum story here.
That's a pretty strong buy there. Nick, Northern Star this year, or year to date I should say, up around 67%. So it's ripped pretty hard. Is there more room to run on this one? Buy, hold or sell for you?
Yeah, it's a buy for us as well. Look, it's obviously ripped as you say, but if you wind back the clock a little bit more, it was in the naughty corner of the gold company classroom. You know, they had missed their production, they'd missed their OPEX numbers, and here we are today. They're at the end of, well, in the middle of, maybe 12 months out from a really big step up in their production with what Marcus spoke about, the KCGM. It's $1.5 billion in 12 months' time. It should start to deliver. It's trading on a market, as in a gold market multiple, and so that growth is not reflected in that multiple. Just to put it into context, I was looking at consensus numbers for production. Between now and the end of the decade, they should produce roughly 1 million ounces more. At $6,000 an ounce Aussie, that's $6 billion. And I also looked at CBA to see what CBA's revenue growth is. It's less than that.
Yeah, right.
BHP's is about half that number. So it gives you a sense of the growth that you know, I think we both see in the company that isn't reflected in the current share price.
Very good. A strong double buy there to finish on. All right, we're going to shift gears for the final segment of this episode of Buy, Hold, Sell. It's one of my personal favourites. I've asked the gents to bring along a stock, a stayer, that they would back for the next 5 years, so that, you know, well-trodden thought experiment of if the market closed, what would be the one stock that you would hold? Nick, what have you got for us?
It's NexGen. Now, most people might not know what NexGen is. It's a uranium developer. So they don't produce today, but they have their foot on some very prospective land, and they have the Rook deposit. So let me just give you a few numbers about the uranium market. Uranium market demand globally is about 180 to 200 million pounds. Supply, mine supply, is about 110, 120. So there's a massive mismatch between demand and primary mine supply. And that's before you add in all the Chinese reactors that are being built, all the Indian reactors, all the Western world reactors. That's only going to add to that mismatch. Now, NexGen have the Rook deposit, which is in Canada, and they will produce 30 million pounds. They will be the Saudi Arabia of uranium when this is up and running, and they will do it at a very, very low cost of about $10 a pound, roughly, versus a price of uranium about $80, $90. Why can they do that? It's because their grade. Mining is a lot about the grade, and their grade is around 10 times higher than a lot of the other competitors. So they only, for every piece of rock that they mine, the other guys have to mine 10 times that volume, right? And that's why the costs are so good. And so if you had to close your eyes and buy something, that would be the one.
That's a pretty strong start, Nick. We are on the home straight, Marcus. Bring us home. What's your pick for the next 5 years, the stayer?
For the next 5 years, the stayer, it would be NextDC.
Okay.
So
That's slightly related, a bit of crossover here a little bit. The power being generated to power the data centres, right?
Indeed. And look, most listeners would be aware, obviously, NextDC, one of our leading data centre owner and developers. Now, interestingly, Chris, NextDC is a company that we have owned for in excess of 5 years. And so, you know, in terms of when I think about this question, it could well be a company that we own for the next 5 years as well. And in that sense, I think we can call NextDC, perhaps from our perspective, it is the trifecta of the season for the next 5 years. And just to really put maybe 3 points around this for why, we really like the industry demand growth outlook. Talk about structural growth. We could talk about cloud adoption. We could talk about AI capabilities. So there's a very strong demand outlook. More specifically to NextDC, we like the company's specific earnings outlook. We view this as infrastructure light with improving returns on equity. And the funding model we think has got better for NextDC. And what we'd expect over time is that the company can also leverage selectively JV capital to help fuel the growth. It is worth noting that NextDC, in fact, over the last 12 months, the share price is actually lower now than where it was 12 months ago. But yet the company has made all these contract wins. So when we look at the stock today, we actually think it's only valuing the known contract wins. And as we sit here to your hypothetical 5 years, every extra contract that drops, we think presents potential upside to value.
Two strong picks to finish the show there. Big thanks to Marcus and Nick for their participation. If you like this episode, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.